As it is with an individual, so it is with a nation. A nation must produce also, or it will become a have-not. That was a quote by Henry George, a 19th century American political economist. Well, businesses also need to produce. They need to produce to survive. But at the same time, they also need to control their costs of production so they make a profit. In this lecture, we're going to be talking about how to measure costs and profit and introduce an important concept called economic profit. The lecture explains why economic costs include both explicit, revealed and expressed, and implicit, present but not obvious costs. We'll relate the law of diminishing returns to a firm's short-run production cost, describe the distinctions between fixed and variable costs, and explain total, average, and marginal costs. We will also review where a firm should produce or not produce depending on a firm's marginal cost and marginal product. During this course, we've talked about how households provide scarce resources that businesses use to produce goods and services in order to make a profit. Those resources cost money. At a macro level, there are two categories of economic cost: explicit cost and implicit cost. Explicit costs, or at the macro level, explicit costs are just monetary payments to households for resources that the firms do not already own. On the other hand, there are also implicit costs, a slightly more difficult concept to understand. Implicit costs take into account resources the firm already owns. So, they could be used to make something else. These types of costs are present, but not always obvious. Think of implicit cost as the opportunity cost of the resources. Let's be more specific. Sometimes the value of the next best use of the resource can be better, i.e., yield more profit. Sometimes it's worse. For example, an automotive firm can use its paint shop to paint cars. But it could also use its paint shop to paint furniture. The implicit cost is the cost of painting the furniture. Implicit costs also include a concept called normal profit, or the profit required to keep entrepreneurs interested in conducting the business. So, the implicit cost of painting the furniture would include a normal profit for entrepreneurs in the furniture painting business. To summarize, economic costs include both explicit and implicit costs. Accountants basically are interested in explicit cost because they appear on the income statement. Economists are interested in economic costs because they look at the value of the next best use. Okay, now we can turn to the calculation of profit. Business students understand accounting profit. It's the measurement of total revenue minus the explicit cost of running the business. If a firm earns $120,000 in revenue by selling T-shirts, and it has material, labor, and other costs of $63,000, then their accounting profit is $57,000. Economists calculate profit a little differently. First, we have to understand implicit costs. So let's go through them. In our example, the owner took out savings from her bank account that was earning $1,000 a year. And it could have rented her building to another firm for $5,000. The owner of the firm could work on another venture at a salary of $22,000. Finally, let's also assume that a normal profit she could make as an entrepreneur organizing a different business is $5,000. Total implicit or opportunity cost is $33,000. Thus, economic profit is positive at $24,000, or total revenue minus explicit and implicit cost. What does this mean? It means that the current business venture of making T-shirts has both accounting profit and economic profit. That the current business is a better alternative than the next best alternative for using the resource. Economists would also say that resources are being allocated efficiently. There is no better alternative for the resources than how they are currently being used to make T-shirts. However, if we now assume that implicit costs are $65,000, then we have negative resource allocation and negative economic profit. Economists like economic profit measurements for companies and for industries, as it more accurately describes the use of scarce resources. So, this is an important concept here, that economic profit can be positive, doing the best that I could with what I have, no other better, or it can be negative, which says a signal that there are other opportunities that we could put these resources to that would make more money. And perhaps we are underutilizing the overall resource base that we are employing in this business. Very, very important concept that you would not get just by looking at accounting profit. For the balance of this lecture, we're going to consider explicit costs only and focus on the short term. In the short term, a business has variable resource inputs like material and labor cost. Firms only use these resources in proportion to the number of products that will be made or services that will be provided. It also has some fixed resources like capital equipment and plants. These do not change with the level of output. The building and equipment will be there if 1 or 100 items are produced. All resource inputs are variable in the long run, and we will review this topic in the next lecture. With short-run costs identified, we can now turn to understanding output or production. So we're going to get into some definitional relationships that we need to understand on the production side of short-run production relationships, okay? There are three measures. Total product is the total quantity of a good or service that will be produced. We're going to use total product in a couple of the modules in this class. Marginal product is the additional output received by adding 1 unit of variable input. In our examples, we're going to use labor as the variable input. Average product is the total quantity of output divided by the total quantity of inputs. In the example shown, labor is the input. Average product is also referred to as labor productivity, an important economic measurement. So we have three here. Total product, the incremental product or marginal product, and the average of what's the total product, the output divided by the total inputs, in this particular case, labor. Law of diminishing returns gives business leaders guidance as to where a firm should set its production. And I just said guidance, right? There are other things that we will learn about where we're going to maximize profit or where we're going to have the lowest cost later on in the semester. But the law of diminishing returns gives guidance as to where production should be set, okay? So here's the key learning. In determining where a firm should produce, at what level, and exactly how much they can get by adding more and more units of labor to produce more and more output, we look at the law of diminishing returns. To understand the law of diminishing returns, we have to make certain simplifying assumptions. First is that the resources are of equal quality. As you add individuals to an assembly line or to a retail service process, you're adding resources of equal quality. That the technology and capital are fixed in the short term. For example, a firm has only one building or a set of machines to make a certain product. Finally, variable resources are added to fixed resources to generate output. So I want you to think of a building that has a certain level of equipment inside. And when we continue to add people to the process in order to produce more and more output. At some point in time, the marginal product, that is the incremental product by adding an incremental unit of labor, is going to fall. Why does this happen? Because of the constraining nature of fixed assets in the short term. Think, you can only add so much labor to a process that has been defined before you start tripping over one another. Or the process becomes so complex that management can't coordinate activities. That's the law of diminishing returns. And it happens because you do have variable resources that are added to a fixed process. And I've seen it where, literally people do trip over one another because there's too many people in the plant or too many people in the process. That is the law of diminishing returns. And the only way to change that is to change the fixed resources. Okay, because you hit that law of diminishing returns. Looking at it another way, I want you to imagine a plot of land that is fixed in size. Okay, continuing to plant more corn in a fixed plot of land will just lead to less marginal corn output for each plot planted. it becomes too crowded. Harvesting becomes more complex. So there are some practical looks at diminishing returns that happen in the real world. This table goes a ways towards helping to explain the law of diminishing returns. Across the top, we have the following columns. Column 1 is the units of variable labor needed to produce more output. Note, labor is increased in units of one person. Remember, there's a fixed level of equipment to produce the output. Column 2, the total product produced with the fixed equipment, and it increases up to a point. The marginal product is in column 3, and that is the incremental product produced with each additional input of labor. The average product in column 4 is just the total product divided by the total resource input. Okay, and I'll just point out here that at a variable resource labor of 4, the total product is 60, and therefore the average product of 2 divided by 1 is 15. Okay, so that kind of sets the table. Okay, but let's concentrate on column 3. This shows that marginal product continues to increase as more labor is added up to a total of 4 units of labor. Up until this point, the firm had increasing marginal product. It went from 1, 10, 2 to 15, 3 to 20, and then when it added its 4th, the marginal product went down to 15, and if you look further down the column, you can see that at some point it actually gets negative at -5. This is where the people really do trip over one another, or management does lose control of the overall process. Okay, so the key here is that total product continues to increase due to more labor being added to the process. However, the output added by increasing 1 unit of labor declines after peaking at 3 units. Also look at column 4. As long as marginal product is increasing, average product will also increase. Stated differently, labor productivity continues to increase. After a total of 4 units of labor, marginal product begins to fall and ultimately ends up negative at a total of 8 labor units. This is where people start to trip over themselves, as I mentioned. As marginal product falls, average product, shown in column 4, also falls, reaching a low of 8.75 at 8 units of labor. The law of diminishing returns should be very obvious starting at 4 units of labor. I'd review this table after the lecture, and obviously review it prior to any quiz or test on the subject. Here is a graphic representation of the table that we've just reviewed. Total product continues to increase through 6 units of labor. More labor, more output. Marginal product increases for a time, then falls. Once the marginal product falls below the average product, it will continue to pull down labor productivity. This gives insight as to where to produce from an input standpoint, as long as the marginal product is increasing. You have increasing marginal returns. On the next slide, we'll look at what it looks like from a cost perspective. So here are the three concepts that we have reviewed so far on output. Total product, marginal product, the increment, or average product, which is the total output divided by total input, or labor productivity. As long as marginal product is increasing, average product goes up. Once marginal product starts to decline, meaning the increment of 1 unit of labor does not yield as much output as the previous increase in labor, the average product will begin to decline, and you will get diminishing marginal returns. And if continued, total product actually falls, management loses control, people trip over one another, and the actual person, that 8th person that was hired, actually goes to the back of the warehouse and sleeps, and their marginal productivity is actually negative. So this takes the three concepts and discusses both the increasing marginal returns and the law of diminishing returns, where to the point where it actually gets to be negative. Short-run costs comprise two components: fixed, variable costs. Fixed costs, like plant and equipment, do not vary with output, as I mentioned. Firms have paid for the equipment and building, and the outlay is the same if they make 1 unit or many. Doesn't matter. Variable costs, material and labor, do vary with output. Total cost is the sum of total fixed and variable cost. Nothing real complex here, just introduces the three concepts on cost as we understood the three concepts on output. And here you can see the relationship of these cost curves on the graph in terms of quantity produced at the bottom, costs up at the top here. And so let's go through these one at a time. Total fixed cost, the red line at the bottom of the page, is $100 at all levels of output. Doesn't change. Variable costs, TVC, increases in proportion to output. Total cost increases in the same proportion, with the difference between TC and TVC represented by the fixed cost. Note that at 4 units of output, total cost is $400, made up of 300 variable and 100 fixed costs. In addition, average cost of each of the concepts is nothing more than the totals divided by the quantity produced. Average fixed cost is highlighted to emphasize that as quantity increases, the average fixed cost will go down. Financial analysts typically call this thinning the fixed cost. The more items produced, the more each unit can absorb the fixed total. Marginal cost is just like marginal product. Marginal cost represents the incremental change in total cost divided by the incremental change in quantity. Average, in a few charts, we will see the relationship between marginal cost and marginal product. Okay? Those are the two concepts that we want to get to on this chart. Thinning the fixed, the average fixed cost will go down as the quantity produced increases, and the marginal cost is just like product. What's the increment? Okay. Little complex table. Okay. And I've tried to do some highlighting here to give you a little better idea of the chart. Obviously, this is one of those charts that you have to go back to and look at in the PowerPoint deck in order to really go through it and understand the concepts. I'm going to do my best job right now to walk you through the detail and relate it to the graphs that we've just reviewed. Okay? I want to focus on a few key columns. Column 1 goes back to output. Column 1 is the total output produced by the firm. Column 5, average fixed cost. As you look down the column, you can see that average fixed cost per unit continues to go down as more output is produced. This is thinning the fixed cost per unit. Okay. Column 6, average variable cost or total variable cost divided by the quantity produced. The average variable cost reaches its low point at 5 units of production. And I highlighted this here at the $74 shown in red. Marginal cost, the change in total cost divided by the change in quantity, is shown in column 8. It goes down and reaches a low point of $60 a unit. Again, I've shaded this in red, at 4 units of production. After that, it starts to go up. You can see that once marginal cost starts to go up, then the average variable cost also begins to increase. So once we get past the point where marginal cost in column 8 begins to increase, if we look back over at column 6, we can see that the average also starts to increase. Okay? Finally, the average total cost of the firm, shown in column 7, reaches its low point of $91.43 per unit. Ultimately, the increases in variable cost outweigh the thinning of the fixed cost, and the average cost starts to increase. Okay, so you can only thin the fixed by so much before that incremental marginal cost takes over, which increases the average variable cost, which ultimately in column 7, after reaching the low point of 91.43, starts to increase. You can see the low points here for average total cost at 7 units of production. This is basically a graph that looks at all of the costs relative to the table that was previously shown. You can see the low points for average total cost at 7 units production and the low point of average variable cost, the gold line, at 5 units. Both costs fall through certain levels of production and then begin to rise. Understanding the low points on average total cost and average variable costs are important tasks for any firm trying to maximize profit. So let's just take a breath here. The average total cost reaches its low point at 7 units of production. Anything beyond that just adds more cost, and the average goes up. The average variable cost reaches its low point a little earlier because of the thinning of the fixed cost. But ultimately, the marginal cost, which reaches its low point at 4 units of production, begins to increase. And once it passes the average variable cost curve, it begins to pull that average up. So, understanding how all three costs relate, marginal cost and the low point there, average variable cost, and average total cost, which ultimately begins to increase last because you can't thin the fixed anymore, are all important concepts to understand that once the low point on marginal cost is reached at 4 units, there are diminishing returns. A firm is experiencing the law of diminishing returns when the marginal costs are increasing. A firm should strive to produce at a point where average total cost is at its low point, the red line, 7 units of production. Remember, the market determines the price of the good or service to be sold. Management is responsible for controlling the cost and therefore the profit of the firm. So you should go back and look at this table here, which relates to the graph on this chart, and you will be able to see that this is just a graphic representation, but it doesn't eliminate the need to understand the key learning. Market determines the price. We need to operate at the lowest average total cost that we can and understand where our law of diminishing return takes hold, and that is once where the marginal cost begins to increase. Here's an important learning. The marginal product curve and the marginal cost curve are mirror images of one another. Marginal cost, inputs of labor, reaches its low point when marginal product, or the output of goods, reaches its high point. By the way, the same can be said for average cost and average product. So again, if you go back and look at the tables, you will see that marginal product and marginal cost, okay, reach its high point for output and low point for cost at the same quantity of output. So just take a look at the two dots, the two black dots on this chart. Top one being, output, bottom one being cost. And you can see the peak of marginal product, the increment, and the low point of marginal cost, the increment, are basically mirror images. And all I've done here is draw the yellow line through the output to show that average product and average variable cost are also mirror images of one another. A firm must understand both output and cost to effectively manage the firm. In the short run, the cost curves can change. If wages increase, then the average variable cost curve would move upward, the gold line, and would alter the red average total cost curve as well. Average fixed cost would not change. If wages or material cost were reduced, then the opposite would occur. So I've tried to relate the gold curve with the gold words on the right-hand side of this chart, that the gold curve of average variable cost are influenced by changes in wages, changes in material cost, changes in the cost of electricity or fuel. They move the average variable cost curve, which obviously has an influence on the average total cost curve. It's the low point where we want to produce. It's a little different for average fixed cost. If there were technological improvements or changes in the arrangement of plant and equipment, or an additional piece of machinery that doubled the productivity of workers, then fixed cost would increase, but output would also increase. So, changes in technology, plant and equipment, those changes highlighted in green on the right-hand side of the chart change the average fixed cost curve, which is also shown in green. Increases in productivity or average output per unit of labor generally decrease the average total cost curve. That's what business leaders are constantly trying to achieve. Let me go through that. Increases in productivity or average output per unit of labor generally decrease the average total cost curve. Lowering the average total cost curve by spending money on equipment that will improve productivity is the responsibility of management. That is how economies grow. That is how the production possibilities curve shifts outward. So you've really got two concepts here. What makes that gold average variable cost curve go up and down? Basically, changes in variable inputs. What makes the green cost curve go up and down and then ultimately influence productivity? Well, it's changes in technology or changes in fixed costs that move that curve. And those are the two relationships that you need to understand.